Hey, y'all, welcome back to Random Gleanings. I'm Chris. He's Jesse. Jesse, we're going to talk about risk.
Yeah.
We're going to talk about what some of our favorite minds are thinking right now. And it's 15 days countdown, Janet Yellen says, for the debt ceiling. So let's start with risk. So when we think about a financial plan, right?
Yep.
You know, our goal is to try to make sure we have enough money for the rest of our lives and we live the life that we've always wanted to live, okay? So it's going to take a certain amount of money to do that, right?
Yep.
And we're going to need to be able to baseline that. And that's like our average goal return.
That's right. Yep.
So if we do better than that, that's good, right?
Absolutely.
If we do worse than that, that's bad.
No bueno.
And so the first chart we have really is just the bell curve. And we have the average, and that's our expected. And anything to the left of that really is not where we want to be.
Yeah, I think that's right. I think one thing about understanding the bell curve is if the average is a positive number in and of itself, slightly to the left is one thing, but when we go all the way out there, they call those tails, and so it's a left tail event or a right tail event. We'll take right tail events all day long.
Yeah, that's good.
Right? That's a good thing. But the left tail you've got to avoid.
If you you know, you go back to certain periods of time, like 2000 to 2009. I mean, the S&P average annual return was negative 2%. I'm not saying that's coming, just saying that's left tail, right?
Right, that's right.
So let's look at what some of our favorite minds say. Let's start with Liz Young from SoFi. You know, we see her on CNBC and some different places, but I mean, at the end of the day, I think she's got some nuggets here. Let's go to her first thought, and I just want to read you something. So on the Tape podcast this week, she talks about checks and balances that she does for herself. She said, if I have a certain opinion that's persisted and I feel like it's not really coming out the way that I thought it would, I sit back and I try to imagine 6 to 12 months from now, if I were wrong, what the headlines would have to look like, right? So if we somehow make it through this period unscathed and inflation comes back down, everybody's fine, profit margins stay afloat, all the things, that would mean the headlines would have to read something like this next graphic. Fed raises rates fastest in 40 years, 5% in 13 months, no issues. Credit tightened, but it never broke. Banks failed, but hey, no big deal. It all worked, everything's fine. These are headlines that I just don't think make sense, and I would absolutely be shocked if those are the headlines that we see at some point in 2024.
Yeah, I think the exercise of putting yourself out into the future to imagine what it would have to look like to break the mental model that you've created for yourself is a good way to just kind of bring things back to baseline, and to her point, those headlines seem relatively unbelievable.
Yeah,
right.
They do. So next picture.
Yeah, I worked up a version of one of these headlines myself.
Jay Powell does look good.
Saw a really smart photo of Jay Powell and thought, hey, that looks like a GQ cover. So yeah,
avoiding recession and looking
good doing it. And on the Apple thing, I think Willie has some comments on that at some point, maybe in another episode. But yeah, it just doesn't seem believable that when all the signs for recession are kind of flashing, that we just
everything's
avoid
fine,
it,
right? So look at the next picture here, which is the speed of interest rate hikes. So you look at different periods and how fast we got to 5. I mean, it's quick. It's super quick. So I drew this graphic. I just wanted you to have a 20-year reference here, okay? So for the last 20 years, only 5 out of those 20 years have rates been not at 5, but above 2%.
Right.
5 out of 20 years in the last 20 years. So think about everything in the last 2 decades in terms of stocks going up. Of course, we had the great financial crisis in there. But look, I mean, at the end of the day, rates have only been about 2% 5 out of 20 years. If you go back and you look at how often rates have been above 5%, it was only about 6 to 8 months in 2007 and right now. And that's it.
Yeah.
Okay? So we don't have a baseline for what this looks like in the last 20 years. So if everybody just thinks it's rosy, look, I don't see how you.
I think there has to be some digestion, right?
Right.
Now, the one thing we want to stay away from on that chart is, oh, look at it's before 2008,
Nah, that doesn't
right?
matter.
And that's
Nah.
not what we're trying to say here, folks. But it is a matter of, Liz Young just said it in regards to 5% in rate hikes in 13 months. That's a very quick way of getting rates much, much higher.
It is. So if you think about that in the context of the bell curve, about is this an average time? Is this a left tail, maybe bigger risk time? Or is this a right tail, hey, everything's great time?
Right.
To us, I think I speak, it looks like a
Well,
left tail time.
let's go to the next
potentially.
slide where Darius Dale, a macro research investor, speaks to the likelihood or the environment that would set up for the right tail, the soft landing.
So this is an answer coming from a question that, hey, what would a soft landing looks like? And Darius goes on to say, basically, in our view, a soft landing is improbable unless the following three conditions are met. Number one, the Fed immediately pivots to rate cuts to quickly offset the damage. Well, we don't know if that's going to happen.
We don't
or
know
not.
that one yet.
The
right.
market seems to think so. The Fed's saying no.
Right.
And, so we'll see. But that's a big yellow because they're saying, that they're not committing to that by any means. In fact, they're saying the opposite. Number two, the Fed does not hike well into a yield curve inversion. And we'll look at that in a second. And number three, the tightening cycle is not accompanied by tighter lending standards. So let's look at 2 and 3 real quick. So next chart, here's the 10-2 yield curve.
Yeah. If you look all the way to the left of that chart, the yield curve inverted for the first time in April of 22. It's a very short little blip.
Yeah, that's right.
But it is always a little bit of a warning sign. It came back up. I will make a note that the very first Fed hike only had happened in March.
Yeah, so you had one hike and the yield curve inverted.
That's
then,
right.
Then you had the yield curve invert again and remain inverted basically since July until now. And there were 7 hikes since that time.
So going back to Darius, the Fed does not hike well into the yield curve inversion.
Well, it has. It has.
Next chart just shows those hikes over that time frame. And I think it's 3.5 of the 5% hikes have happened since July.
Right.
And that was 7 consecutive Fed meetings in a row.
Yeah, which is the bulk.
Right.
Okay, and number 3 of his point was the tightening cycle is not accompanied by tighter lending standards. So here's a chart of the top 25 banks for the last 1 year period. And I drew little yellow lines there. And the reason for that is to basically say, hey, this is the top 25 banks. This is JP Morgan, B of A, Wells, Citi, U.S. Bank Corp, all the way down through the rest of the top 25 banks across the country. And they need to crest above at least one of those lines to make you think that they're in a bottoming process. So what do lenders have to say?
Well, interestingly, that report came out just last week. It's they call it the SLOOS. And, right there in the first 3 paragraphs of the SLOOS report,
they said tighter standards 5 times.
5 times. And that covers businesses, real estate, and households. Okay, so banks are reporting, or the senior loan officers are reporting that they are, in fact, tightening standards, which, again, is one of those notes that Darius says makes for the improbability of a soft landing at this point.
So, lastly, is a picture of Janet Yellen, Judgment Day. She says it's 15 days away. She says that there's a warning that time is running out and, quote, people's lives hang in the balance to avert an economic catastrophe if the debt ceiling isn't lifted. A little bit hyperbolic there, but, the intent is to try to get Congress moving. Biden's supposed to go to Asia this week, but may not happen if things aren't resolved. It seems unlikely it will be resolved. So they've got days and not months now until this comes up. And by the way, if you go into other debt ceiling challenges where there were challenges yet again, I mean, is that a good times event or is that a not as good times event?
Well, if nothing else, it certainly puts people on the edge of their seat as to what's going to happen, and that's generally not a good sign for market positivity.
So again, in the context of a goal, in thinking about, a modal outcome, an average kind of outcome, right? The center of the bell curve. That's what we want in our planning for the future. We'd love to have right tail, better than expected, right? But the environment may not give us that. And if it gives us more left tail, then or more risks could be to the downside, not to the upside. We've got to be prepared for that and be thinking about that. And, from my viewpoint, at least, we're in challenging waters here.
I think, the dirt has been stirred up in the water, and you need to kind of let that settle down to make sure that before you go grab something in that water, you know what's in there. So,
listen, we'd love to say something positive to y'all. We really would, but it's just not showing up yet.
Yeah.
I mean, this morning when we got ready to video, and by the way, it's Tuesday, May 16th right now, about noon. I mean, Home Depot had missed their earnings. People not spending on their homes. People aren't moving.
Retail sales were up, but missed pretty bad to the upside. So they were much lower than expected, which again is just another indication that some of this stuff is starting to show up in regards to a slowing economy and again, recessionary signals.
So you can look at things from an index standpoint and from a sector standpoint, both on a market cap weighted basis, which means the biggest companies have the biggest percentage share, or you can look at them on an equal weighted basis, which we'll often do to just see what's going on with the average company under the surface. I can tell you this morning, after retail sales missed and Home Depot missed, I can tell you that 11 sectors on an equal weight basis, all of them were down.
How many sectors are there total?
11.
Right. So
Yeah.
11 out of 11. Not a good score.
Not a great score at all.
Yeah.
All right. We'll say something positive at some point. That's all I got.
I got one thing positive to say. I want to shake your hand. Today marks 12 years that Chris and I have been working together. It was May 16th of 2011, so that's why the whole 11 debt ceiling debate is very, very, again, memorable to me, is that we had only just started working together.
Yeah.
And here we are 12 years later having the same conversation.
Absolutely.
So,
Good stuff.
yeah. Thank you all for watching. I hope it was meaningful to you today. Sorry for the negativity. We do look forward to positive days. But please hit the subscribe button. We're going to just keep you informed along the way. Thanks.